Every single year, a company's founder sits down and writes a letter to shareholders. Most of these letters open with confidence, growth numbers, optimism, a vision for the year ahead. In 2000, one of those letters opened with a single word. Ouch. That was it. The entire opening sentence of the annual letter, from a company most people today would confidently call one of the greatest business success stories in modern history. At the time, though, nobody was calling it that at all. The stock had just lost almost everything it was worth in under a year. Analysts were writing its obituary. Competitors were already gone. This is the exact same company that would eventually go on to become worth well over $1 trillion in real, verified market value. Almost nobody actually watching that crash happen in real time believed that outcome was even remotely possible at the time. The year was 2000, and the internet was supposedly, confidently going to make absolutely everyone rich beyond their wildest expectations. Pets.com had a widely recognizable sock puppet mascot, an actual Super Bowl advertisement, and a business model that reliably lost money on every single order it shipped out. Wevin promised to deliver groceries directly to your door and burned through nearly $800 million of investor money before collapsing entirely and shutting down for good. Cosmo.com would bring you a candy bar for absolutely free, with no delivery fee attached at all, and somehow genuinely expected that particular model to work out financially over the long run. Then the bubble finally burst, and it burst remarkably fast, catching almost everyone in the entire industry completely off guard. These specific companies, and dozens of others very much like them across the industry, disappeared within months of one another entirely, taking billions upon billions of investor dollars straight down with them into nothing at all. Amazon had actually invested real, meaningful money in some of these exact companies as part of its own early business strategy. It watched them fail up close, in real time, right in front of it, not from some safe, comfortable distance far away. And its own stock was cratering right alongside everyone else's stock during that exact same brutal stretch of time. In December 1999, Amazon's share price had peaked somewhere around $107 to $113. By 2001, it had fallen all the way down to roughly $6 a share. That's a decline of about 94%, erasing somewhere near $14 billion in market value in less than 2 full years. Wall Street analysts weren't just mildly skeptical anymore at this point. Several openly predicted, in print, that Amazon would eventually run out of cash entirely and follow Pets.com and Wevin straight into bankruptcy. The company had genuinely never once turned an annual profit in its entire history up to that point in time. It was spending aggressively on warehouses and infrastructure while losing money on nearly every single sale, in an environment where investors had suddenly, sharply stopped tolerating that particular story. If you had genuinely been watching the news in 2001, Amazon wouldn't have looked anything like a company about to become one of the most valuable businesses on the entire planet. It would have looked exactly like the very next name on a rapidly growing list of internet-era casualties, simply waiting for its own turn to arrive. What actually kept it entirely off that specific list traces back to one deliberate decision, made more than a full year before any of this crash even started to unfold. Her name was Joy Covey, and in January 1999, she was serving as Amazon's chief financial officer, closely watching a business that was growing remarkably fast, but also burning through cash even faster than that growth could sustain. Covey made a genuinely consequential decision that, in hindsight, is now widely credited by business historians as the single most important financial move made in the company's entire early history. She personally led a convertible bond offering, ultimately raising $1.25 billion total in fresh capital, which was more than double what the company had originally, conservatively planned to raise just months earlier that same year. At the time, back then, that decision might have looked to outside observers like unnecessary overkill, or even excessive caution bordering on paranoia. Amazon didn't strictly need that much money to fund its current, day-to-day operations at that specific moment. Raising far more than seemed necessary meant deliberately taking on real debt, real ongoing interest payments, and real dilution risk for existing shareholders, all in exchange for a financial cushion the company might genuinely never end up needing at all. But Covey wasn't planning specifically for the environment Amazon happened to be operating in during that particular month. She was planning, whether consciously or not, for a different environment that nobody could reliably predict with any real confidence at that point. And the deal itself closed roughly a full year before the dot-com crash actually hit the broader market with full force. When the bubble eventually burst in 2000 and 2001, capital markets froze almost overnight, seemingly without warning to most observers. Companies that suddenly, urgently needed to raise fresh money simply to survive found almost no one willing to lend it to them under any reasonable terms whatsoever. Venture funding dried up rapidly and completely across the entire industry within a matter of weeks. Banks grew sharply, noticeably more cautious with every single passing week that followed. Pets.com, Webvan, and dozens upon dozens of other similar companies discovered, far too late to do anything meaningful about it, that the money simply wasn't there anymore once they actually went looking for it. Amazon didn't have that same problem at all. It already had the cash sitting safely in the bank, raised more than a full year earlier, well before anyone had started to panic, before the borrowing terms got dramatically worse, before that entire financing window closed completely and permanently. Covey herself would go on to be widely remembered within the company and across the business world as one of the most important, if quietly underappreciated, figures in Amazon's entire early history. She wasn't the public face of the company in any real sense at all. She wasn't the one giving keynote speeches or appearing on glossy magazine covers. But the specific financial decision she championed and executed, at a moment when almost nobody could have predicted exactly why it would matter so much, is precisely the reason there's a story left to tell about this company surviving it all. That single decision, made quietly while the party was still going strong for everyone else in the industry, is exactly why Amazon had the crucial breathing room that virtually everyone else in this story was so desperately, fatally missing when it mattered most. Jeff Bezos himself later described that specific period at length, in his own words, across his collected shareholder letters and several separate public interviews given years afterward, long after the immediate danger had fully passed. What he actually said reveals exactly how he was thinking internally, while nearly everyone else on the outside assumed the company was already finished. At the pinnacle of the internet bubble, our stock peaked somewhere around $113, Bezos recalled clearly. And then after the internet bubble burst, in less than a year our stock went down to $6. His annual shareholder letter covering that period, as mentioned earlier, opened with that single, blunt word, ouch. That's the crash itself, described plainly in his own words. But what he actually did next is the real point of this entire story. The stock is not the company, and the company is not the stock, Bezos said, explaining his thinking at the time. As I watched the stock fall from $113 to $6, I was also watching all of our internal business metrics. Number of customers, profit per unit, defects, everything you can imagine. Every single thing about the business was getting better and fast. While Wall Street was watching the collapsing share price and assuming the very worst about the company's future, Bezos was watching an entirely different, more granular set of numbers internally, and those specific numbers were telling him a fundamentally different story. That distinction didn't mean the company simply coasted through the crisis untouched, riding on pure optimism alone. In 2001, Amazon laid off roughly 1,300 employees, about 15% of its total workforce at the time, as part of genuine, deliberate cost discipline rather than blind faith. This was an optimism dressed up convincingly as confidence. It was a company actively cutting real costs while simultaneously trusting, based on hard internal data, that its underlying fundamentals remained genuinely sound. We didn't need to go back to the capital markets, Bezos later said directly, crediting the exact cash position Covey had personally secured more than a full year earlier. The bond raise and the internal cost discipline weren't two separate, unrelated stories happening at the same company. They were fundamentally the same strategy, playing out simultaneously in two entirely different departments at exactly the same time, pointed toward exactly the same outcome. This kind of transparency about a near failure is genuinely rare among founders, even years later, once the story has a happy ending to soften it. Most business leaders, looking back on a 94% stock collapse, would understandably want to downplay it, reframe it, or simply avoid discussing it in much detail at all. Bezos instead chose to describe it plainly, repeatedly, in his own words, almost as if the specific mechanism behind the survival mattered more to him than the crisis itself ever did. He wasn't simply being stubborn or refusing to acknowledge an obvious reality unfolding around him. He had actual internal data supporting his confidence, data that most outside observers watching the stock ticker had absolutely no access to at all. That specific gap between what the market could see from the outside and what the company itself could see internally is exactly what made the real difference between panicking and holding steady through the very worst of it. It's genuinely worth pausing here for a moment and looking directly at exactly what happened to the other companies that never had Amazon's specific, deliberate combination of advantages working in their favor. Pets.com had raised over $11 million in its own initial public offering less than a full year before shutting down completely and disappearing from the market entirely. It genuinely had real brand recognition, real media buzz, and a mascot that people all across the country actually recognized on sight, sometimes even fondly. What it fundamentally didn't have was any viable path to actual profitability, and it didn't have anywhere close to the cash reserves needed to survive a prolonged downturn, while it tried to figure that path out along the way. Webvan, for its part, built an enormous, expensive infrastructure of fully automated warehouses before it had ever genuinely proven that enough customers actually wanted the specific service at a price point that covered the real cost of delivering it reliably. When investor money eventually dried up almost overnight without warning, there was no fallback plan whatsoever, and no financial cushion left to fall back on when it mattered most. Compare that directly, and quite honestly, to Amazon's actual position during that exact same industry-wide crisis. It already had the cash Covey had personally secured a full year in advance of the crash. It had a founder actively, personally tracking internal metrics that were genuinely, measurably improving in real time, not just publicly insisting they were fine for appearances. And critically, it also had a business model deliberately built around fixed costs that would eventually become profitable at sufficient scale once the company grew large enough for that particular fixed cost structure to finally start working firmly in its favor. That last specific point mattered absolutely, genuinely, enormously to the entire outcome. Bezos himself pointed to it very directly and clearly. At a certain sufficient volume level, the company's existing infrastructure would fully cover its fixed costs, and the business would become genuinely, sustainably profitable going forward. Pets.com and Webvan never once, not even close, reached anything approaching that necessary volume before their available cash ran out entirely and permanently. The difference between these particular companies wasn't simply optimism versus pessimism, or plain confidence versus quiet doubt. It was cash versus no cash. It was a real, genuinely workable plan versus no coherent plan at all to speak of. And it was time versus no time whatsoever to actually let that plan play out fully in real, measurable results, month after month, without the entire company collapsing underneath the pressure before that plan had any real chance to prove itself against the numbers everyone was watching so closely. Surviving the immediate crash itself didn't mean Amazon bounced back quickly to where it had confidently stood before. Recovery, in this specific case, was genuinely slow, entirely unglamorous, and stretched out patiently over many long years, not weeks or months as the popular version of this story tends to imply. Amazon's actual stock had peaked at roughly $107 to $113 back in December 1999. It genuinely wouldn't return to that exact same level again until October 2009, nearly a full decade later than the original peak. Think carefully, quite honestly, for a moment about what that actually means in real, practical terms for anyone who lived through it directly. Someone who genuinely held onto their shares through the entire crash, believing steadily in the eventual outcome despite everything, spent almost 10 full years underwater on paper before simply breaking even at all, let alone seeing any real gain. That's genuinely not the specific story most popular. Widely shared retellings of this history actually choose to tell audiences today. The commonly repeated, simplified version skips directly from "the company nearly went bankrupt" straight to "it eventually became a trillion-dollar company," almost as though the many years sitting quietly in between were nothing more than a brief, unimportant footnote worth skipping past entirely. They very much weren't a minor footnote at all in the actual, complete story. They represented a full decade of patiently, carefully rebuilding lost trust, rebuilding thin operating margins, and rebuilding the entire underlying case that this specific business model genuinely worked reliably at real, enormous scale. During that same decade, Amazon kept steadily expanding into categories nobody had initially associated with what started out as an online bookstore. Electronics first, then toys, then countless other entirely different product categories, one after another, expanding steadily year over year, while beyond anything resembling the original bookstore that most people still associated with the company's name at the time. Eventually, in 2006, an internal infrastructure project that had originally started as a practical way to manage Amazon's own internal computing needs was spun out into an entirely new public product, Amazon Web Services. Nobody watching the stock gradually crawl back toward its old highs in 2009 was seriously thinking about cloud computing as the company's actual future direction. AWS was still genuinely small, entirely unproven at any real, meaningful scale, and remarkably easy for outside observers to dismiss as nothing more than a minor side project unrelated to the actual core retail business everyone still associated with the company. It would take several more years after that before its true, eventual scale finally became apparent and undeniable to anyone watching from outside the company itself. The recovery itself was genuinely never a single, dramatic moment worth pointing to directly. It was a full decade of countless individual decisions that, taken one at a time, looked genuinely unremarkable and forgettable, quietly compounding over time into something the panicked 2001 headlines never once predicted or even seriously considered as a realistic possibility. Remember that specific letter from the very beginning of this video, the one that opened with a single, blunt word. Ouch! That letter was written by a founder personally watching his own company's stock sit at just $6 a share, quietly wondering whether the entire company might not even survive that particular year at all. That's exactly where this entire story started out, back at its lowest, most uncertain point in its history. Here's where it actually, ultimately went from that exact point. Amazon Web Services, the exact same internal infrastructure project that nobody outside the company took seriously back in 2006, quietly became the underlying backbone supporting a huge share of the entire modern internet as we know it today. By the 2010s, AWS was generating billions upon billions of dollars in genuine profit annually, effectively subsidizing Amazon's famously thin retail margins and completely turning the entire company's finances inside out in ways almost nobody had originally predicted or even seriously considered possible. Amazon Prime, launched all the way back in 2005 as a simple shipping subscription that almost nobody at the time genuinely predicted would ever matter much at all, went on to become one of the single most successful subscription products in modern business history, quietly locking in deep, lasting customer loyalty at a scale most competitors struggled to match for years and years afterward. By 2018, Amazon officially crossed $1 full trillion in total market capitalization for the very first time in its entire corporate history. By 2021, it had climbed even further, reaching roughly $1.7 trillion in total value, cementing its place firmly among the most valuable companies the entire world had ever seen assembled in one place. The exact same company that had once stood on the edge of collapse. The exact same founder who wrote that one-word letter. The exact same fixed-cost logic Bezos had been quietly tracking internally back when the stock sat at just $6, insisting the underlying business was genuinely getting better even while nearly everyone else on the outside assumed it was quietly dying. There was genuinely never one single dramatic moment where Amazon suddenly became a trillion-dollar company overnight, all at once, out of nowhere. There was a stock that fell 94%, a full decade spent patiently, quietly rebuilding from that low point, and then years of steady, compounding growth built directly on decisions made while almost nobody outside the company was paying any real attention, back when the headlines had already confidently written the ending everyone assumed was coming for good. That particular dramatic ending everyone confidently assumed was coming for good never actually arrived at all in the end. So what's actually genuinely worth taking away from a business story this dramatic, once all the specific numbers and quotes have been laid out clearly? Not buy stocks that crash 94% and simply hope for the best possible outcome without any real evidence behind that hope. That's genuinely not what actually happened here. And treating this story that way would completely miss the entire point of telling it. Most companies that fall this dramatically far never recover at all, under any circumstances. Pets.com and Webvan represent the far more common, statistically realistic outcome in situations exactly like this one, not Amazon's own unusual, specific path forward. What's actually genuinely worth taking from this particular story is the specific distinction Bezos himself kept returning to repeatedly, over and over, in his own words across multiple public interviews. The stock is not the company, and the company is not the stock. A falling stock price tells you what other people currently believe about a business in that exact moment in time, often driven heavily by fear, momentum, or outside events that have genuinely nothing to do with the actual business itself. It doesn't automatically tell you whether the underlying business itself is actually healthy or quietly dying out of public view. Those are two genuinely different, entirely separate questions to ask. And Amazon's specific, remarkable story only truly makes real sense once you actually learn to separate those two questions clearly and consistently from one another, rather than treating a falling share price as automatic, reliable proof that a company is fundamentally broken beyond repair. That particular kind of separation only actually worked for Amazon because there was something real and substantial underneath it to genuinely separate in the first place. The cash reserves were genuinely real. The steadily improving internal metrics were genuinely real and verifiable across every category tracked. The fixed cost logic pointing toward eventual, sustainable profitability was real and verifiable. This particular story isn't fundamentally a story about optimism simply winning out over pessimism in the end. It's a story about one specific company genuinely having the real financial cushion and the real underlying business fundamentals needed to survive long enough for that important separation to actually matter and play out. While dozens upon dozens of similar-looking companies without those exact two things simply ran out of time entirely before anyone watching could even tell the real difference. So think carefully about that specific letter one more time. The one that opened with just a single word, ouch. Wasn't written by someone who genuinely knew, with any real certainty, exactly how this entire story would eventually end. Bezos was writing this during the actual crisis itself, in the middle of it, not looking back on it comfortably from a place of safety years later. He genuinely didn't know yet, back then, that AWS would ever matter at scale, or that Prime would eventually become what it became, or that the stock would take a full decade just to get back to even breaking even. What he did know at the time was actually narrower than that, and arguably far more useful in the moment. The specific internal numbers he could genuinely see, on the inside of the company, that Wall Street simply couldn't see from the outside. This channel exists specifically to dig into exactly these kinds of real business stories, the ones with actual, documented numbers sitting behind them, instead of just a compelling headline repeated without verification. If today's video genuinely gave you a clearer picture of how a real company actually survives something like this, subscribing means you won't miss the next one in this series. Before you go, I genuinely want to know honestly, what specific part of this story actually surprised you the most? The 94% stock crash itself? The full decade it actually took to recover? Or the simple fact that Bezos was this openly candid, years later, about exactly how close it actually came to going the other way entirely? Drop it in the comments section below right now. I read every single one, and there are genuinely plenty more real stories like this one still left to tell.